Hey everybody, welcome to the morning market briefing. Thursday, July 28th, 2022. Big day. GDP is out. You can probably pull that number up faster than we are going to get to it, but we do have the number. We are going to get to it in just a moment. Going to open up though with some earnings updates. Ben, Meta reported saw for the first time ever a decline in revenue. Zuckerberg took, I thought, a pretty harshly different tone in terms of what they're trying to put across their stocks down 5%. What's your read through on all this?
Yeah, I think that we've gone from you're playing whack-a-mole when you're looking at Facebook. Last year, you were looking at the Apple iOS tracking headwinds and those really coming and denting growth. And then you had in January, the big news was TikTok was gaining share on the advertising. It was getting more competitive. That was a big issue. And so each time they tried to play that whack-a-mole. So now you're finally lapping over those tough periods on the iOS tracking, which should make for better comparisons. And you're actually building a lot of engagement on Instagram and Facebook Reels. That's up 30%, really driving some engagement there. The problem is it doesn't monetize as well. And then on the top of that, you have the macro impact. So now you're dealing with the macro impact. So you're going from issue to issue to issue with Facebook. I would say that Meta, I would say that the positive for Meta is that you're going from more idiosyncratic to more macro. And if you're dealing with more macro cyclical forces, I think the market is more prone to look through that, especially for a company with a franchise like Meta. So again, I would take the conclusion that the company is solidifying its user base and is now just taking in by some of the more macro headwinds. Interestingly, this was the first quarter of revenue decline that Meta has ever had, and they expect another quarter of decline next quarter. So not in a great spot right now, but I would say maybe the lipstick on the pig would be that this is more macro issue and more macro related than a micro issue like we've had before with them.
Yeah, so your hope there would be that they're tactically and strategically kind of improving the operations. They're going to weather the storm. Maybe they come out a little more focused.
Yeah, they're really working on, they're kind of just copying TikTok. And I think that Zuckerberg, that's exactly what he's done throughout his entire career. And he has no shame when it comes to that. Just a year or two ago, he was talking about rebuilding the community, doing less suggested content, less news articles, and more just family updates, friends updates. And he completely is tacked right back to recommended content. And he's now leaning into that just like TikTok.
Interesting. Ford up about 6%. Really nice quarter. Good pricing, good mix. North American margins were significantly stronger than expected. They're putting a huge emphasis on affordability, trying to keep that at the forefront of what they're doing. They say they have not seen demand come off at this point. Ben, of all the companies that I could have listed that I thought would have a pretty solid quarter, I don't know that I would put Ford real high on the list.
Yeah, I think when they're talking about affordability, they're talking about doing 72 months payback period than 60 months. Having said that, I do think that it was a good quarter. Pricing is very strong. Interestingly, the state with the highest average monthly loan payment is Texas, and Louisiana and Mississippi are all up there in terms of average car payment per consumer. I thought that was just an interesting statistic. You would have thought maybe some more.
Everything's bigger in Texas.
Yeah, you just have more debt.
Trucks aren't cheap.
Trucks are not cheap. They would expect maybe some pricing declines in the back half of the year as volumes pick up, but right now they're not seeing that. So a good quarter from Ford, and I would say that probably the big differentiator between Ford and GM right now is the fact that GM has already done its cost cuts, and Ford is doing its cost cuts now, which means that the rate of change is going to be better at Ford than at GM in terms of cost cutting and operational efficiency. And as a result, Ford just increased its dividend by 50%, which is a big move. So that is really attractive when you compare it to GM's dividend yield of 0.
There you go. Rivian, the new electric truck manufacturer, cutting 6% of jobs. They're trying to simplify their product roadmap, really get focused on where they can be most impactful in deploying capital. They're having troubles with inflation, with high costs, harder and harder to raise money. All of the things that you would expect that would be a challenge for a startup vehicle manufacturer in this environment are impacting them. Stock's actually flat on that news, but worth noting, Best Buy, meanwhile, has preemptively cut guidance. This was not a scheduled report. Their quarter finishes in July, but they're expecting comps to be down 11% versus a prior guide of being down 3 to 6%. Quote here, as high inflation has continued and consumer sentiment has deteriorated, not that there's any signs of that, customer demand within the consumer electronics industry has softened even further, leading to Q2 financial results below the expectations we shared in May. So not a shock there, but interesting timing on that. Meanwhile, Diageo, people are still drinking.
Yeah. People are drinking a lot. Volumes were up 10%, pricing added another 10 points. So they were up 21% in revenue, profit up 26%. So they're getting some really good pricing there as well. They did give their fiscal year ends in June. So they gave guidance for the full fiscal year, and it was relatively cautious and conservative, but the numbers are the numbers, and the numbers are really good for Diageo. It's not up really, at least it wasn't earlier. It was about flat pre-market, but at least here in the US. But I think the numbers are strong, and Johnny Walker especially performed extremely well.
Interesting. I don't know. Who drinks Johnny Walker, man? Not me.
Not me.
Wow.
Maybe occasionally at a wedding, scotch and soda, you got to stay hydrated, but otherwise.
Yeah. Pfizer has actually raised guidance. Pfizer's raised guidance. They reiterated some of their guidance and Paxlovid guidance, despite the headwinds. Paxlovid usage is really accelerating, as you might imagine. President Biden was on TV yesterday, hyping it up, saying you don't even have to see a doctor to get Paxlovid, which seems reckless in my opinion, but is what it is. We got Amazon and Apple and Intel reporting tonight. Let's jump to GDP. We've got some other stories that we'll kind of wrap up with, but GDP, Tom, do you have the data?
We have the data. So as early as yesterday, the survey was for a 0.5% gain. That was actually revised down overnight. So the live number on Bloomberg was actually 0.4% coming into the morning. And we came in at negative 0.9%. So depending on who you ask, if you ask us, we are officially in a recession as of this morning. So we've had 2 consecutive quarters of contraction in GDP. And traditionally speaking, that is the indicator. There's going to be, obviously, Jenny Ellen's going to speak at 1:30 today. I think she's going to put her best effort into saying that it's not, and give a lot of rationale for that. But I think it's
a recession.
Yeah, it's a recession. And there's no harm in saying that is one. I mean, it was going to happen, and here we are. So, thoughts, boys?
Yeah, I mean, it's interesting. I mean, we'll get to Fed commentary in a moment, but you essentially had Powell out there saying like, hey, we got to do this. We got to cause a recession. Then you got the other side of the table saying there is no recession. It's like, let's try to get on the same page here in some way. And let's at least be even just academically honest with what the definition of a recession is. We're in a recession. We've been saying we're in a recession since, I don't know, May on this call.
Since as soon as we saw the first quarter, we thought, well, that's that.
Tom, what was the price index or the GDP price?
So the survey on the GDP price index was 8%, and it came in super hot at 8.7%.
Okay, so I think the market may look through this then in that case. So a few things. First of all, we're going to, in all likelihood, not be revised positive. We may be revised, but the typical revisions are, 0.5 to 0.6. So we're still we'll probably, even if we get revised higher, we'll still probably be down. Couple interesting things. Inventories, a draw of 2.01% on GDP. So you back out inventories, you keep inventories flat, and GDP would actually be positive. Net exports did help this time. Net exports were a help of 1.43, which is a little bit anomalous because usually, at least recently, net exports have been a draw to where the GDP number comes out. last quarter. And in fact, in Q1, it was negative 3.23%. So we would have been positive had that net exports number been flat. But inventory is the big number, down 2%. So I wouldn't be surprised if Yellen uses that in her talking points when she speaks at 1:30 today. Because if you just keep inventories flat, you would have posted a positive GDP report. Now, that doesn't change some of the negatives that we see in this report. And some of those negatives include goods, which went from a negative 0.3 posting in Q1 to a negative 4.4 posting in Q2. So that declined. And you're thinking, okay, well, maybe it's going to services, right? So services were up 3 in Q1. And if goods fell by 4 points, services only raised by 1 point to 4.1. So we are seeing a shift from goods to services, but it's not nearly as much as we would have liked. You're also seeing a decline in non-residential investment that went from up 10% in Q1 to actually down slightly. So a lot of enterprises pulling back on investments is something that we've seen from earnings reports. And then the big one, though, is residential fixed investment. That went from up 0.4 to down 14. So a huge decline in home building. And I think that's really drawing on results. So I think the big headlines that I see is you're seeing a shift from goods to services, although it's not really enough on net. You're seeing a decline in fixed investment, especially on the new home side, and that you saw a draw on the inventories. And also you saw a higher than expected price index, which people might say, well, it's just inflation that's eating into this. So I think ultimately there's a lot here. I mean, there's a bunch of numbers, so there's always going to be something that people on both sides can take and look at. I actually think that this report is a little bit better than I would have expected.
Yeah, I mean, we talked right before we got on here. I thought we'd be down 1.2. I'm very interested. I mean, it'll be a while to see the revision. I mean, GDP now has been saying it would be at negative 1.6, I think. Will be interesting to see just kind of where this settles out. Although the reality is, as it relates to market impacts, like this is the number. There can be revisions, but no one really redigests the numbers over and over, I don't feel.
Yeah.
Tom, in light of that and what we just talked about with the GDP, what the actual print was, does that inform or change anything that Jay Powell said yesterday?
I mean, that press conference, I mean, he looked, shell-shocked is the first word that comes to mind, but it was really more
rudderless,
exhausted. Yeah. Like everybody just kept pounding him with questions about what are we doing if there's a recession? And he kept saying, we're going to try and avoid one. There probably isn't one, but he basically was just doing the song and dance. They told him to go out there and say there's no recession, despite the fact that
there clearly is.
Yeah. Less than 24 hours later, here we are. I mean, it was tough. I mean, I think the indicator is that they are leaning towards like they might be more dovish in the future. In my opinion, the way he was speaking was saying that, they either may pause or they may slow down going forward. They're going to be data dependent. As always, things change. He basically said there's no way of knowing where we are, 6 to 12 months from now in a normal environment. But, this is not a normal environment. So it's even harder to know where we are, which basically says we don't have any idea what's happening. It was a pretty rough press conference. It was exceptionally boring. He basically just kept saying, it is what it is. Here we are. We're raising rates. Why are we raising rates? We don't really have a great rationale for it. Why are we raising this much? We don't have a great rationale for it. Are we going to keep doing it? I don't know. Maybe, it was pretty rough. That being said, I think this does change the narrative. I mean, if you look at the bond market now, it is flipped totally towards the recession narrative. And we are seeing the bond market on fire right now. We're still super inverted. That's a function of the raise yesterday. But the 10-year treasury is flirting with a 270. I mean, that's exceptionally low from where it has been. The 30-year yesterday dipped below 3%. We're right about 303 right now, which is exceptionally low for the year. I mean, it's game on for bonds right now, particularly on the long end. I think there's a lot of value in kind of that 3 to 5 year space, particularly if the Fed overshoots and they've got to start cutting in February, as is indicated by futures now. It's a great time to buy sort of that short to intermediate term bond. But I mean, I don't know. We're just in recession mode now. Inflation is not affecting the bond market right now. People aren't pricing bonds like inflation is an indicator anymore.
Yeah, it's just a weird switch. I mean, we've been heading that way. We've been looking at portfolios and trying to figure out how we position them through this. I mean, the oddest thing to me, yesterday was one of the more confusing days I've seen in terms of market reaction, with the NASDAQ being up over 4%. I mean,
I think it was definitely taken dovishly. So I think that Powell basically said, we're going to start slowing that down the pace of rate increases unless something changes, which frankly, I mean, we had German CPI today, which was much higher than expected.
Yeah, I just don't think the inflation thing's changing.
I don't think it's going away. I mean, if you look at inflation forecasts from anyone, from Goldman, from economists, the core inflation is expected to go up all the way through November. So when we're looking at data in September and November, I mean, it's only going to get worse for the Fed, and that's on the core inflation side. So I actually think that dovish thing was a little bit short-lived. If you're looking at companies, I mean, you're having companies all over the place, whether it's Mondelez, whether it's Visa, whether it's all these companies talking about raising prices in the back half of the year. Price increases that haven't even gone into effect yet are going to go into effect to the tune of 10%. Chipotle is raising prices next month. So we're not through this inflation at all. You already have real goods in decline, which, I mean, incidentally, we haven't talked much about Amazon, but that's not going to be good for Amazon when that reports later today. If real goods are down 4.4%, that's going to be tough on their margin. My opinion is that we're trying to look through this. Enterprise spending is pretty good right now, but Powell was asked multiple times, will you stop into a recession if inflation isn't down? And he basically said, look, it is what it is. We got to bring demand down. And he kind of just shrugged. He's like, I just kind of almost speechless. He says, yeah, it's going to happen. And he expects more weakening in the labor market. I don't know what the initial jobless claims number was this morning, but he expects more weakening in the labor market, significant weakening in the labor market. And if Jay Powell even alludes to that in a press conference, you know there's going to be significant impacts.
Yeah.
Because he's not going to say, get out, watch out. He's going to say, you know, we could see a little bit move higher. And then it's like, next thing you know, it's 6%. Because if there's one thing that we know is that the Fed cannot fine tune an economy. No. He's not going to be able to measure it to. So we go from 3.6 unemployment rate and increase 0.1% every month to 5%. It's going to overshoot. It's going to overshoot big. And I think that's the concern right now.
Yeah. So initial jobless claims came in hot, 256,000. And they also revised last month up another 10,000, 261,000.
So this one will be, and we keep seeing these upward revisions too. So this will be revised up to 265.
Yep.
And that 4-week moving averages continues to go up, and we'll be 300,000 by the fall.
Yep. Last thing we got, Joe Manchin has signed off on the Inflation Reduction Act of 2022. This needs to unanimously pass with every Democrat senator in order to get it through on reconciliation with a simple majority. This will make, they're touting it as a historic down payment on deficit reduction to fight inflation. They're going to invest in domestic energy and manufacturing, reduce emissions, all of these things that are obviously at top of mind. The details of it, not all that interesting, to be honest with you. It's relatively straightforward. 15% minimum corporate tax rate, prescription drug pricing reform, IRS tax enforcement, changes to the carried interest loophole. They're going to spend $369 billion on energy security and climate change, $64 billion on the Affordable Care Act. I don't really know what this accomplishes other than just saying, well, we passed something.
Yeah, I mean, and frankly, I don't know why the Republicans don't just sign off on it, because I don't think that they'd have a issue having Amazon pay higher taxes. That's what Trump wanted. I don't think they'd have an issue actually upholding the law. And they wanted prescription drug reform too. Carried interest loophole, I mean, that's just de minimis. You're going from a 3-year holding period to 5-year holding period. On the EV stuff, I think Manchin made a clear point that he wants to have fossil fuels as well. They're also giving money to new technology and fossil fuels. So we're actually leaning into that. We have a couple of oil servicers that lean into that. But overall, I don't know why the Republicans wouldn't sign off on this too. It just seems, I just don't think it's going to do much.
Yeah. It seems relatively, from a policy standpoint, relatively neutral. But it's a chance for you if you're, at the Capitol building to act like you've done something.
By the way, the amount of spending they're looking at on the EV tax credits, if $369 billion was all for EV tax credits, you'd have to sell 61.5 million electric vehicles. That's a lot.
Man,
That's a lot.
That's a lot. Shout out to Rivian. They're going to have to hire back 6% of their workforce.
And that's means tested too. So it's all income tested. So you have to be making less than $75,000 for an individual, $150,000 as a couple in order to get that credit for an electric vehicle.
It's crazy. All right. Well, we'll wrap it up there. Wild day. Just as we wrap it up, looking at futures, not a lot of movement on that GDP number. Down S&P futures down about 20 basis points. NASDAQ futures down about 0.5%. It's kind of where they were when we started the call. So, we'll see what happens. Talk to you guys tomorrow.